probably be back at 3:40.
Yeah. Okay, so today we are going to continue working our way through itemized deductions. We'll talk about some deductions today that are not itemized, but we're going to talk about taxes and interest today, and we're going to start on charitable contributions. Charitable contributions we will have to finish on Wednesday, which is the last class period. And I know sometimes people don't go to class on the last class period, but I would encourage you, you really should, if you don't, watch the lecture, because you will have material on your exam for the charitable contribution. You have multiple questions, and it is something that's highly tested on the CPA exam, if you're remotely thinking about that, and it is something that is not the most intuitive. I don't know why Congress makes it so complicated for individuals to take a charitable contribution, but that's what the law is. So, let's pick up with taxes. So we've spent some time looking at a Schedule A, and of course you filled out a Schedule A for your 1040 assignment. So one of the things on Schedule A is taxes. So there are certain types of taxes that you can deduct on Schedule A. Not all kinds, but some. The common ones being real property taxes and personal property taxes. So some things that are not considered to be deductible as property taxes, sometimes local ordinances will have some sort of special tax that they have to build a street or a baseball field, something like that. And you vote on it, you know, as taxpayers in that area. Do we want to have this special amount, extra amount to build a baseball field or something like that? Something like that is not considered to be a deductible real property tax. So these are the normal real property taxes that you have assessed, you know, on your property every year. I just got mine from Smith County where I live Friday. And of course, the value on my property, you know, they upped it by like over $50,000 in 1 year. It's ridiculous. So anyway, but I'm going to go contest it. So anyway, and I encourage you to do that when you buy property. It's kind of fun actually to go in there. You know, they have a courtroom set up, and it's kind of informal one. And you can go and contest your personal property tax valuations. And often all you got to do is show up to contest it when they will adjust your value. So anyway, so we have real property taxes, and some states have taxes on personal property. So these are things like cars, boats, I don't know, computers, you know, things like that, something that's not real property. One thing to note with personal property taxes, you only get to deduct what is an ad valorem tax. Ad valorem is Latin for value added. That means the piece of the property tax that is based on something other than the value of the property is not deductible. So there's a simple example in the book, and actually it is on the slides too. So I'll tell you what, I'll just scroll through the slides real fast because it is in the slides and it's in the book. So these taxpayers, which were in the big picture facts, which I said I didn't want to use, which we're not using, but they have in this hypothetical, they pay personal property tax on their car. So this state basically has two ways that it's taxed. They tax 2% of the value of the car and 40 cents per hundredweight. This taxpayer pays $412 last year in property taxes for this car. How much of it is going to be deductible? Only the percentage that is based upon the value of the car. Here, 2% which is the tax rate, times the value, which is $20,000, which is going to be $400. So out of this 412, only 400 of it is going to be deductible. The remaining 12, because it's based upon the weight of the car, is not deductible. Some taxes that are not deductible, and this is actually in your book on page 1012, there is Exhibit 10.2, which lists out some taxes that are deductible versus some that are not deductible. Some that are listed in the book as not being deductible, FICA, just like employment taxes, excise taxes, estate inheritance and gift taxes, foreign income taxes, those federal income taxes, all those are not deductible. The big ones that are, of course, property taxes and state income tax or sales tax. Which brings us to the next slide. We're not actually, this slide is about real property taxes for the year that a property is sold. All it stands for is that you have to apportion the property taxes between the buyer and the seller in the year of sale. We're kind of skipping this problem, but that's how that rule works. You're not tested on the apportionment between the buyer and the seller. Okay. And then we'll talk about state income tax or sales and use tax. So as you saw in your problem, you can deduct either state income tax or sales tax. How do you know which one to deduct? Whichever is highest, right? Whichever is highest. And you do have some problems on your exam where they give you a whole list of 4 or 5 different taxes. And they'll say, what is going to be your itemized deduction for taxes? And they'll list both state income tax and sales tax. Do not deduct both of them, right? Just use the highest one. So state income tax includes amount that's withheld during the year. It includes estimated payments that you've made during the year. And if you paid any amounts in the current year for a prior year liability, that would also be something that you would deduct. For sales tax, there's 2 different methods you can use. You can either deduct the actual amount of sales tax that's paid, i.e. you keep your receipts, or there is a sales tax table that is put out by the IRS. I've done this. It's like a questionnaire. They ask you these questions, and then they tell you, okay, based upon, the size of your family and where you live, your estimated sales tax is $1,000 or whatever. And if you use the amount from that table, you don't have to have receipts. So those are your 2 options. Remember, in Texas, we don't have a state income tax. So if you're preparing your tax returns or for a client, the sales tax table may be important. Because a lot of people don't keep their receipt when they go to Target or they go to the grocery store. Most people don't. I may have told y'all, over spring break, I filed my own taxes, and we bought a house this year, so we itemized our deductions for the first time. And I kind of wasn't thinking about it, or I don't know, I didn't really think about it. But I realized, I should have been keeping up with all these receipts for things, because I can deduct my sales tax this year. This is the first year I'm going to be able to do it. So I spent part of spring break looking through, my filing cabinet and my email and my Amazon account, and I had a little spreadsheet trying to find all the sales tax that I could. And I found, like $3,000 worth of sales tax. So it was pretty, fun, right? Getting to go through everything. But I buy a lot of stuff online. And we bought a washer and dryer and fridge and a lawnmower and all the things you buy when you buy a new house. So paid a lot of sales tax. Okay, the next item on Schedule A is interest. There are different types of interest. We have interest on student loans, investment interest, resident interest, and business interest. So depending upon what type of interest you have, it will affect where it is deducted, which is really just a good point to bring up, period. So if you own your own business, your expenses are going to be entered on Schedule C, right? So if you have Schedule C and you own your own business, certain types of expenses that would maybe otherwise be an itemized deduction are going to be reported on Schedule C. For example, if you have a home office deduction and you have mortgage interest and you own your own business, that part related to your house is going to be on Schedule C, but part of it, whatever's left, will go on Schedule A. So we have the same item, mortgage interest, that is reported differently depending upon the taxpayer's situation. Specifically, do they own a business? Another example, we have a business owner. Let's say they're a CPA. They own their own accounting firm. Every year, they have to pay their occupational taxes to the state of Texas to be licensed. Those occupational taxes are not, well, they could be on Schedule A as a miscellaneous business expense, but because he owns his own firm, they're going to be reported on Schedule C, right, as a business expense. So depending upon the classification of the taxpayer, where these expenses are reported on the return will differ. And you do have a problem like this on your exam. You know, it'll list a bunch of different types of taxes. It'll list 4 or 5 different kinds of taxes. And it'll say, okay, what's this taxpayer's itemized deduction? Second question, what's this taxpayer's above the line deduction? And some of the taxes in the list aren't deductible at all. Some of them are deductible on Schedule C as a business expense. Some of them are deductible on Schedule A as an itemized deduction. The ones that would be deductible on Schedule C, of course, are going to be ones related to his business. Would he have any that are maybe deductible on Schedule E? What do y'all think? Remember what Schedule E is used for? Rental income, right? So if he has some mortgage interest related to a rental house, then that would be reported on Schedule E. So just remember that depending upon the situation of the taxpayer, it will affect how it shows up on his return and what type of a deduction he or she receives. So, general rule, personal interest is not deductible. General rule. Of course, there are exceptions, the large one being qualified resident interest, because that's related to your personal house, but you get to take a deduction for that interest. So the first type of interest we're going to talk about is student loans. Student loans, you can see up here in the slide, it's an above the line deduction. See? For AGI. For everybody. It doesn't matter if you own your own business or not. Everybody gets an above the line deduction. It's on line 33 of page 1. You only get $2,500 per year. That's it. If you are married, you do not get $5,000, you get $2,500. And if you're married filing separately, you get 0. We've talked about marriage penalties throughout the semester. This is definitely a marriage penalty. You're getting treated differently if you are married than if you had not been married. Often, spouses have both, if one went to college, often both went to college, and they both have student loan debt. But you're still only going to be capped out at $2,500 a year of interest that you have to pay, which is not very much. So there's also a phase out, as you can see on slide 36. If you are single, between 65 and 80, and if you're married, between 130 and 160. So what happens if we're going to do a problem? What happens if your adjusted gross income is, and you're married, filing jointly, is greater than 160? What happens?
You don't get a deduction.
That's right, you don't get anything, right? This is the phase out threshold between 130 and 160. So if you have AGI, or modified adjusted gross income, and you're married, that's less than 130, you don't have any type of phase out. If it's greater than 160, you don't get a deduction, period. You get nothing. So let's do an example. This is example 20 in the book on page 1015. We have Kurt and Rita, who are married and filed jointly. They pay $3,000 of student loan interest. Their AG, or modified adjusted gross income, is $137,500. So the first question, what is the maximum amount of student loan interest that they would be able to deduct before the consideration of the phase out? That's right, $2,500, right? So we know they're definitely not going to be able to deduct $3,000. Definitely not happening. $2,500 is the max. Do we have to consider the phase out here? Yes. Because $137,500 is in between 130 and 160. A lot of these phase-out calculations work the same. So we have $137,500, which is their modified adjusted gross income, minus the lower end of the phase-out, right? Over $30,000, because $30,000 is the difference between the lower end of the phase out and the high end of the phase out threshold, right? 130 to 160. If they were single, you would be over 15,000, right? Because 65 and 80 is 15. The reason why we do it this way is because once you pass 160, you don't get any deduction. So essentially what we're doing here is creating a ratio. We want to know what percentage are they over the threshold, which is why we have a denominator of 30,000. It's good to remember why we're doing this, because a lot of these phase-out calculations work the same. You have a different number for the phase-out, but the way that you actually calculate it is the same. So here, $2,500 times essentially our ratio here. This is their modified adjusted gross income. And that equals $625. So is $625 the amount of their deduction? No, absolutely. That is their reduction. So we're calculating the amount of the reduction here. So the amount of their deduction is going to be $2,500, not $3,000, okay? $2,500 minus $625, which equals $1,875. Okay. That's how student loan interest works. And remember, student loan interest is an above the line deduction for everybody, whether you own your own business or not. The next type of interest, qualified resident interest. There are two types: acquisition and home equity. So acquisition indebtedness has a maximum principal allowed of $1 million And home equity has a maximum principal allowed of $100,000. And this is actually $1 million if you're filing jointly. So, let's talk first about acquisition indebtedness. So acquisition indebtedness is very much, you're buying a house, you go to the bank, you get a loan, and they give you, $150,000 to buy a house or to build a house. So that, and it is secured by the house, which is important with acquisition indebtedness. It must be secured by the house. What does that mean when we say it's secured by the house?
They'll take your house if you don't pay it.
That is right. They will come and take your house if you don't pay. Legally, you own the house. Practically speaking, the bank kind of owns the house, right? Because until you finish paying off that loan, you don't pay, they'll come take your house and sell it and take the proceeds. So, in order to qualify, it has to be secured by the house. Okay. This is probably on the next slide, 38. It has to be $1 million for jointly. It's $500,000 if you're married filing separately. So I said that wrong. It is $1 million, I guess, for everybody, but if you're married filing separately, it's $500,000. That's technically the correct way. $1 million for everybody, unless you're married filing separately, and then each spouse gets $500,000 apiece. And then with home equity, it's $100,000 for all taxpayers, or $50,000 for married filing separately. So a home equity loan, I'll show you. Let's say you go to the bank and you buy a $200,000 house. So your house costs $200,000. But you only get a loan for $150,000. So we have $150,000 is the amount of the loan. So how much equity do you have in this house? What do y'all think? $50,000. Why is this? Because you owe $150,000 to the bank. Honestly, what that means is the bank owns, really practically speaking, $150,000 of your $200,000 house. You have equity for the difference between what is owed and the value. So next year, the value of your house may go up. Let's say it goes up to $210,000. Now how much equity do you have? $60,000. Well, what about if the market plummets and the value of the house goes down to $175,000? Well, now you only have $25,000 of equity. So equity is based upon two things. One thing you can control and one thing you can't. The thing you can control is how much money you owe on the loan. The thing you can't control is the market. So there are really two components to calculating equity. So a home equity loan is when you go to the bank and you say, hey, I really want to redo my kitchen. I don't like it, it's old, there's popcorn ceiling, whatever. So you say, I want to get a loan with the home equity of my house. So essentially what you're doing is giving the bank this equity. You're securing the loan with equity. So let's say the bank gives you a $30,000 home equity loan to go in and work on your kitchen. So that means the equity of your home is the security for this loan. Now, with a home equity loan, something that's important to remember is the proceeds can be used for any purpose. So with an acquisition loan, the proceeds of the loan have to be used for what? To buy the house, right? Or to build it. With a home equity loan, they don't care what you use the proceeds with. If you go get a $30,000 loan and you take it and you go to Vegas and go gambling, it doesn't matter. It is still deductible home equity interest. So long as it is based upon the equity of your house, it doesn't matter what you use it for. Now, notice how I say you are capped at 1 million or capped at 100,000. That is of principal, okay, not interest. A taxpayer is, if you say they're capped at a $1 million interest deduction, that's not right. Think about what kind of house that is. If there's $1 million of interest every year, that's not what we're talking about. We're talking about $1 million of principal or $100,000 of principal on the loan. So let's look at an example. This is example 22 on page 1016. Larry owns a residence with a home market value of $450,000. Okay? And an outstanding first mortgage of $420,000. So this is the fair market value. This is the mortgage. First mortgage means that's the acquisition indebtedness. Then he takes out a home equity loan of $15,000 and buys a car. So how much is his interest deduction going to be based off of? $435,000 of principal. What's the interest expense deduction? Whatever the interest is from these loans. We don't know, we're not given that in the problem. Please note, this is not the amount of the deduction. This is just the amount of the principal. The amount of the deduction is whatever interest we have associated. One other thing I will mention with acquisition indebtedness that I forgot to a minute ago. It covers your principal residence plus one more. So if you will remember back when we were talking about rental properties, we said you could deduct mortgage interest from that rental property. That's your one more, okay? So you potentially get two properties. Your principal residence where you live and maybe a rental property. But if you will remember, back when we talked about this, there were three scenarios for rental properties. Primarily rental, primarily personal, and the hybrids of part personal, part rental. There was one category where we said you do not get a mortgage interest deduction. Do y'all remember which category it was?
Primarily personal.
Primarily rental. Because when you're at primarily rental, it is not personal mortgage interest anymore. It really is becoming all business interest, essentially. So if it's primarily rental, then you don't get to take your mortgage interest deduction because this deduction is available for personal interest. So if it is interest on something that is purely rental or purely business, we are not saying you're not going to get to take the deduction. It is just not going to be a deduction that you get to take here. So, okay, let's see. couple other things related to mortgage interest on slide 42 is something called points. Okay? So if you have points, points are when you're going out to get a loan for a house and interest rates are down. So you decide you are going to pay down the interest rate now so that you get a lower interest rate over the life of the loan. It's called a point. All it means is, okay, I'm paying the lender $1,000 now so that over the life of this 20-year loan, I get, 0.2% reduction in the interest rate monthly. It's basically all you're doing. So generally speaking, and these slides are a little bit backwards, honestly. Generally speaking, if you are going to get a loan with acquisition indebtedness and you pay for points up front, you can deduct that all immediately. And that's actually on the next slide where it says you can deduct it all immediately. If you are paying for your mortgage on your principal house, you can deduct all of your points immediately. If you are refinancing, you can't. So if you're refinancing and you pay points, they don't let you. You have to amortize it over the life of the loan. But generally speaking, if you're getting paying for points, because all you're really doing is just paying interest up front. That's all you're doing with points. You're just paying the interest up front so that you get a lower interest rate over the life of the loan. So they do allow this to be deductible so long as you're not refinancing. Next category, investment interest. So this is where you take out a loan to purchase some type of investment property. It could be stocks, bonds, or land held for investment. You do get to take a deduction, but as you can see on slide 44, the deduction is limited to your net investment income. So you can take a deduction. It is an itemized deduction on Schedule A, but it is going to be limited to your net investment income. Some other topics in here that discuss interest. If you are taking out a loan to purchase some sort of tax-exempt property, so what would be a good example of tax-exempt property? Like maybe something you saw on your 1040 assignment. What pays tax-exempt income? Anyone? Maybe a municipal bond, right? Pays tax-exempt income. If you take out a loan to purchase a municipal bond, the interest on that loan is not deductible. So that's an exception. You are purchasing a loan for investment, but you essentially don't get two tax benefits. The first tax benefit being you have a bond that pays tax-free interest. The second benefit being taking a deduction for the interest on that loan. You don't get both benefits. The code only allows you one, and that's the tax-exempt interest income. You do not get to take a deduction for that interest expense. We don't see this a lot with individuals, but with corporations, this is something sometimes they'll do, and you don't get to take a deduction for that. There are no real limits on deducting interest expense for related party loans, FYI. And this is a good slide here, slide 46. So that what this slide stands for is kind of something I've been saying all along. Depending upon what the loan is used for will affect where it is reported on the return. So if we have student loan interest, It's above the line. If we have a business loan, and there's some interest there, that's Schedule C. If you have mortgage interest from a rental property, that's Schedule E. If you have just your personal residence, that's Schedule A. If you have investment interest, I don't know if that's on here, but that's going to be also on Schedule A. So depending upon what the loan is used for, will affect how it is reported on the return. Okay. So, our next topic we're going to discuss, we are not going to finish it today. You can get started on it. So I made this chart up to kind of help, honestly, I made it help me with charitable contributions. But you can use it yourself on the exam or whatever. So this chart, we're really not going to get to it probably till next time. But these are the questions, that there are multiple questions you ask with charitable contributions. And all the questions on this sheet, which is front and back, really has to do with how much of a deduction do you get. There are preliminary questions you need to ask before you even get to that point, which is what we're going to discuss today. The preliminary questions before you get to the point of, okay, well, how much of a deduction do I get? Okay, so we're not really talking about that piece of it right now. Okay, so the first real preliminary question is, all right, is it a gift? Is it a charitable gift? There must be donative intent and you expect nothing in return. If you do exceed something with tangible benefit, the gift equals the benefit or the amount paid minus the benefit. So let's look at an example in the book. Example 25. Ralph purchases a ticket at $100 for a special performance of the local symphony, which is a qualified charity. So he paid $100 for a ticket to a symphony from a qualified charity. The normal cost of a ticket to see this symphony is $35 to the public. So he pays $100, he gets a $35 ticket in return. How much is his gift? That's right, 65, not 100, because he is receiving something of tangible benefit, the $35 ticket. So his gift is going to be $65. Now, I'm not necessarily saying 65 is deductible. I'm just saying this is how much of a gift he has. Now, what about if he receives the ticket but he doesn't use it? Still $65. What if when he makes the $100 contribution, he says, I don't want the ticket? Now what? Well, now he gets the full $100 because he's not actually receiving something of tangible benefit. He said, I don't want the ticket, you keep it. Some things that are not considered to be a contributable gift. Services. No services. This is not considered to be a gift to charity or charitable contribution gift. So let's say we have a taxpayer and they are a painter. They normally get paid $100 an hour to paint, and they go down to Baton Rouge to help paint for Habitat for Humanity. They spend 10 hours painting. At $100 an hour, that's $1,000. They spend $200 in gas to get there. They spend $400 in lodging once they get there. How much of this is going to be considered to be a gift for purposes of the charitable contribution deduction? What about the $1,000 for services? No. Services, although it's great and you should do it, but you don't actually get the deduction. What about the gas? $200. Yes, gas is good. Gas is considered to be a charitable contribution. The lodging of $400, also a good charitable contribution. The gas rate is 14 cents a mile for charitable contribution. So this taxpayer's deduction, or not his deduction, the amount of his gift, I should say, would be $600, not $1,000. We don't know the amount of his deduction. Okay. There are some things listed on here, I think they're on the next slide, things that are not going to be considered to be gifts under the charitable contribution rules. Some of these things are pretty common. Value of blood given to a blood bank. It's great that you give blood, but that's not a charitable contribution. For one, I don't know how you calculate the value of that. Maybe the real rare forms of blood are worth more than the more common. I don't know. So, gifts to individuals. If you see someone homeless on the side of the street and you give them $50, again, that's not considered to be a charitable contribution. It's not deductible at all. Raffle, bingo, or lottery tickets from your church, from sororities or whatever, that's also not considered to be a charitable contribution. They're not deducted. Dues to country clubs, lodges, other types of groups. The cost of tuition, that's not a charitable contribution. If you let your church use your property as a parsonage and they don't pay you rent, that is also not considered to be a deductible charitable contribution. I'll just put down here. No specific exclusions. This same list that's on slide 50 is also in the book on page 1020. You can take a look at some of the non-deductible items. It's the same list in the book as is on here on slide 50. Okay. The next question you need to ask is, when is it deductible? The rule is when paid, irregardless of if the taxpayer is cash or accrual. That is when it is paid. The third thing to consider before we get into the calculations is, have the proper substantiation, has that been met? Meaning, has there been proper record keeping? Depending upon what you are contributing, there are different record keeping or valuation requirements. I'll put that, record keeping / valuation. So if you look in the book at page 1022, concept summary 10.2, this chart lays out the different substantiation requirements for charitable contributions. So for instance, if you're looking at this chart, if you have a cash gift, you have to have a proper receipt showing the name of the charitable organization and the date and the amount. A written statement is required if it is more than $75 and is partly a contribution and partly for goods. If it's a non-cash gift, you have to have a receipt from the charity. Clothes or others must be in good condition or better at the time of the gift. And you can take a look, I'm not going to read them all, but take a look at the substantiation requirements for the different properties. Okay, so these are kind of your, what's the word? Your pre-qualifying questions. So you ask these questions first before you get to the questions of really calculating the amount of the gift. The next three questions have to do with calculating the gift and are on that sheet that I handed out. So we'll go with 4, which is who or what type of organization is the gift contributed to. So we're assuming that we have a gift, 1. 2, assuming it is deductible this year. 3, assuming all the substantiation requirements have been met. Now, let's get to the 3 questions that determine how much is our gift going to be. First question, or how much of a deduction, I should say, are we going to get? What type of organization is the gift contributed to? Okay, so that's our fourth question, I should say. Our fifth question, and our sixth one, which we're not going to get to this time, but I'm going to go ahead and write them on the board so you have them all together. What is the value of the property being contributed? And then the last question, what is the limit to the charitable contribution and any carryover? So 5 and 6 we'll get to next time. But let's go ahead and discuss number 4 right now. What type of organization is the gift being contributed to? For purposes of the tax code, well, I'll put it this way. For purposes of this provision of the tax code, there are really only 2 categories. Okay? We have your basically your regular nonprofits, which are called 50% charities, and private operating foundations. So private operating foundations are considered to be 50% charities, but I write it on there separately so that you don't get confused by the next category. The next category is private non-operating foundations. So let me talk about these a little bit. Okay, so if you look up here on the board, it says the IRS puts out a publication number 78, as it says on slide 51. This is updated annually of the list of all the different domestic charities that are out there. These are charities that if you donate to, so long as you're donating a gift, etc., you can qualify for the charitable contribution deduction. Some things that are not on this IRS publication that are definitely charities. Things like churches. This list does not say First United Methodist Church of Nacogdoches on it. We cannot go through on this list and list all the churches that are in the U.S. Think about how long that would be for East Texas alone. Okay, so all the churches are not on here. The schools, if you donate to some sort of school, educational institution, governmental organization, those are all considered to be good nonprofits. They are not going to be on this list. Just because they're not on the list doesn't mean that they're not a good, 50% charity. So these are the normal types of charities that you think about, like churches, schools, governmental entities. Private operating foundations are going to be things like the American Heart Association, the Alzheimer Association, the American Red Cross, the Bill and Melinda Gates Foundation, things like that. So how do you know the difference between a private operating foundation and a private non-operating foundation? A private non-operating foundation is when the foundation does not use the proceeds to basically extend its exempt purpose. It talks about this. Where is it? No trouble finding it. There we go. I'm sorry. It's on page 1024. So a private non-operating foundation is when the taxpayer is not using its income in the active conduct of its charitable undertaking for which it was established. So how do you know if what you're contributing to or what your client is contributing to is a private non-operating foundation or a private operating foundation? You have to call them and ask. That's the short answer. You have to call the foundation and ask them this question. And it changes every year. So there's no real easy way to do it. It's not published in an IRS list. You just have to call the foundation and ask them, are you private operating or private non-operating? You would hope that if you contribute a substantial sum, they will send you some sort of documentation in the mail at the end of the year to use on your tax return that will tell you if they are operating or non-operating. But you may have to call, and it changes every year. So these are the two different categories of nonprofits that you can donate to. Honestly, this category includes pretty much everything. You could think of it that way. We have private non-operating foundations, and then everything else. Maybe that helps you to think of it that way. I know it bothers some students to say, well, why do we call them 50% charities? Well, that's what the code calls it, honestly. But if it helps you just think, okay, we have private non-operating foundations, and then we have everything else. And if you look, that's kind of the first question I have on the front page. Note there are more questions that we talked about. We had questions 1 through 3, which are not addressed on this handout. But these questions are really getting to the nitty-gritty of calculating the limit. So when we come back on Wednesday, we are going to finish doing the charitable contribution, and we are also going to look at a Schedule A in detail, and we are going to calculate phase-outs for itemized deductions. So please plan to come on Wednesday. Also, I noticed only 5 of you had filled out a course evaluation. Please do that.